Have you ever watched CNBC, NBC, or other stock market videos here on YouTube and just wondered to yourself, how the does this shit work in the first place? Why should I buy something that has a large possibility of disappearing, especially if I know nothing about it? Well, after this, you should know something about it, at least enough about it to know whether or not you want to participate. What's up, you guys? This is Derek West from BTP Fusion. Here on BTP Fusion, we love to talk about the synergy between business, technology, and personal finance. If that sort of thing is up your alley, or scratches your itch, or is really your cup of tea, I want you to nuke that like button and moidalize the subscribe button while giving that notification bell a gentle massage. That way YouTube lets you know when we drop more great content. Well, the stock market. Bulls, bears, big cap, little cap. Lots of terms and jargon that can intimidate even the most astute observer. But just what is it? Where did it come from? Why do people put money in it? What can it do, or more importantly, not do for you? So what is it? The stock market is a market for stocks. Duh. Well, sure, but what is a stock? A wide definition of a stock is a share in the ownership of a company. More precisely, it is a type of security. There are other types out there. Stocks are just one of them. But a stock signifies ownership in a corporation, and it represents a claim on part of that corporation's assets and earnings. There are two types of stock, common and preferred. These different types of stock grant various rights to shareholders. A holder of a stock is a shareholder, and technically has claim to a part of the corporation's assets and earnings. So essentially, a shareholder is the owner of a company. And like we said earlier, a stock market is a place where buyers and sellers go to negotiate the price of and buy or sell stocks. A key point to remember is that the stock market is really a secondary market where the original owners of the shares purchased from the issuing company sell their shares to potential buyers, kind of like used cars or hand-me-down clothes. So in reality, the New York Stock Exchange is really just a hand-me-down store, the most expensive hand-me-down store on earth. So you don't actually purchase stocks from the issuing company. You purchase them from existing shareholders. Likewise, you don't sell them back to the company either. You sell them to the original investors. Wait. Where on earth does the original investor come from? To figure that out, let's dive into something called an IPO. To do that, we need to think a bit more deeply about the origins of the company in question. Oftentimes when a company forms, it is just the person who runs it and maybe one or two investors. They typically split the profits by the number of investors. Let's make it concrete and give you an example. If we have a company that, say, makes $100 in profit a year, pretty low, but good for our example, and it has 4 investors, those profits are split 4 ways among those initial investors. So $25 each per year. When this company is looking to raise more capital to expand its original operations or to buy out its initial investors, it works with investment banks and other entities to go public. That is to say, have an initial public offering. So you know what a stock market is. You know how initial stock is issued. And you know how people go about buying and selling the stock. But how is the price of a stock set? The most common number of ways that it is set is through an auction process where buyers and sellers place bids to offer to buy or sell. A bid is the price at which somebody wishes to buy, and an offer or ask is the price at which somebody wants to sell. When those two numbers meet, that is when the magic happens and a trade of shares is made. That kind of sounds weird. A trade of shares. You know what I mean. But what you typically think of when you think of the stock market is really an indices. An index represents aggregated prices of a number of different stocks, and the movement of an index is the net effect of the movement of each individual component, or stock. When you see the Dow Jones Industrial Average, S&P 500, or the NASDAQ go up or down X amount of points, remember that it is a weighted average of a number of stocks going up or down by a point. And by the way, a point is equivalent to $1. That can be kind of confusing. Owning individual stocks, not necessarily trading, can be a great way to build wealth. It's one of the big three of personal finance, along with owning real estate and starting your own business. The only problem is that most individual stocks in trustworthy companies that get great returns are really expensive, as it should be, as most everyone wants to be invested in these companies that are proven entities. This is where speculating on the growth of stocks comes from. Stock investors are looking for a valuable stock that they believe will rise in price before everyone else knows about it. They are doing this in the hopes that their purchase will be valuable enough that at some point they can sell some or all of their stock to someone else if and when they need the money, thus profiting. There are all sorts of fees and costs associated with purchasing individual stocks. Not as much as there used to be, as stocks are now mostly available online through online brokers who ask for a reasonable fee, mostly, for providing you with information on the stocks that you want to purchase, as well as the mechanisms to actually purchase the stocks. But this, combined with people looking for a way to hedge against loss, has led to the creation of all kinds of financial instruments and investment funds. Now, you've probably heard of a mutual fund, index fund, exchange traded fund, or a hedge fund. Each of those are different implementations of the same principle. Spread out your risk among a basket of stocks and trade them in an attempt to beat the market. They all have different legal and technical structures, but they are all meant to solve the same problem, protecting yourself against the risk that stocks that you own will fall in value. Mutual, index, and exchange traded funds can be considered passive, as they tend to just pick a basket of stocks and other securities, and the owner of the fund either lets the fund manager pick the stocks for them, or they just follow the index in price. And this kind of leads us in a roundabout way to the 401k. The 401k is the most common way that the general American public is invested in the stock market. Your 401k is a way for you and your employer to invest in your future by purchasing stocks through a pre-tax investment vehicle. Generally speaking, quite a few, if not most, 401ks are invested in mutual funds, ETFs, or other passive investment instruments. Now, there is literally so much more to the stock market. If I were to go on and on, this video could easily be over 2 hours in length, just going over the basics. But to spare you that indignity, I'm going to end it right here by saying this is the 1,000-foot view of what the stock market is for the completely uninitiated. So with this newfound or possibly reinforced knowledge, how are you going to take advantage? Do you feel like investing in individual stocks is the way to go? How about mutual funds or ETFs? Do you have a 401k? Is it invested in any of these investment vehicles? What's its allocation? All these are sort of personal questions, and to be honest, I don't have a right to know. Comment down below telling me to mind my own business. And don't forget to like, subscribe, and click the notification bell for more great content from BTP Fusion.